Today, I want to talk about a case study. Actually, I'm going to talk about two case studies. The first case study is going to be a borrower who earns about $140,000. By the way, this is a real case study of real people. $140,000. They live in the DC area, not trying to buy exactly in DC, but in the DC metro area. So 140,000 is decent earning, but you need quite a bit of earnings to afford anything in that area, right? They have about 400,000 of student loan debt. They have worked in public service for the government for 15 years. So they have significant work history. They have a law degree, higher education, doesn't matter if it's a law degree, but that's how they accumulated that amount of debt. And they're a week out from closing. And the underwriter says they cannot accept their student loan documentation from their loan servicer, Nelnet, federal loan servicer. They can't accept it because it talks about an estimated payment. It doesn't give an actual payment. It doesn't define when exactly the due date is. It's a pretty generic letter, and the underwriter says we can't accept this. We have to use 1% of your student loan balance because they're trying to qualify the borrower for a Fannie loan. So that's 1% of 400,000, which comes to $4,000, which, by the way, disqualifies you from being able to afford a home because your income is not sufficient with a $4,000 debt. Your back end debt to income ratio, essentially, back end means after they count the mortgage, is too high. You cannot qualify for this house anymore, and you're at risk of being denied this loan. Okay. So essentially, the lender did not know what to do because without the right documentation to have a lower payment count, then the borrower can simply not qualify for the home with their current income and the fact that they have a $400,000 student loan balance. Okay, so what can we at LoanSense do? We at LoanSense will take the letter from the servicer and see what it says. We understand the underwriting guidelines, so we understand that there's a requirement to actually have an expected payment date and a payment amount, and that there's 12 months of remaining payments in order to accept that payment. So we know the requirements. So essentially, every servicer operates a little differently, but the issue with this particular person's loans was we needed to get their payment down below $4,000. It needed to actually be under $2,000 for the back end ratio to make sense. And from the loan officer generating an estimate in our software, which, by the way, you can get access as a lender and an LO for free at lender.myloansense.com, she saw that we can help this borrower get around a $1,200 payment, which will allow the back end ratio to work and qualify for the mortgage she was hoping to close on. So, by the way, and they thought that the borrower would have around that payment initially in the process based on the estimated payment after this forbearance time period. But it turned out that the borrower wasn't actually enrolled in this program. So let me give the borrower a name, by the way. I'm going to call the borrower Jane because it's nice and generic. So Jane comes to us and says, what do I do? I'm supposed to close in a week. My realtor said I can extend the closing date, but I need to get the right documentation. The loan servicer, their mortgage lender does not know what I need to do in order to get the right documentation, but it's telling me I should get an estimated payment of $1,200. Why am I not getting this? Why are they not giving me the right documentation I need for underwriting? What do I need? So as at LoanSense, what we do is we have the borrower answer 7 questions. They connect to their servicer. We see exactly what loan programs are on, the history of repayment in their loans, and then we assist them in understanding what the proper documentation is that they need to submit to get the student loan servicer to send back the right letter. Okay. So essentially the issue with this case study was that only half of Jane's loans were in an income-driven repayment program. The other half were in standard. So when she initially went to request another letter that says, I want to actually enter repayment, they sent her back a letter that was almost $3,000, which again was too high to make the back end debt to income ratio work. So LoanSense was able to quickly identify that other sets of loans had to be entered into income-driven repayment, in which case we file a letter that asks for all loans to be entered into income-driven repayment. And then we essentially request, and the request is done different by different servicers. Some you can request with a letter, others you can request verbally, others you have to refile the entire income-driven repayment application again. So every servicer works differently, but asking for all loans to be kicked into repayment. So the result of this is Jane asked for an extension of the close date. The initial request that Jane made by just calling her servicer came back in error with the $3,000. So by filing our requests into the portal, which was a letter for this specific servicer, they gave Jane a turn time of 3 to 5 days to provide the right letter so that Jane can get to closing. So that's the process Jane is currently in now. Super excited for that result. That's one case study. Underwriters and obviously loan officers know that even if they know that consumers and borrowers can use income-driven repayment, they may not always be 100% sure on how to work with the student loan servicer side to get the results and the documentation they need for underwriting. So that's case study number one. I just wanted to share that because that happens to a lot of people. They try to just go file into income-driven repayment themselves. The servicer, they may have checked the wrong fields, or the servicer may have made an error. And not all loans get put into income-driven repayment, especially if that borrower has undergrad and grad school loans, okay? Sometimes consolidation applications are required, but not always. We try to not consolidate loans because everybody thinks, oh, you consolidate right away. But consolidation can take 2 to 3 months. And so we try to get around consolidation, especially if they're direct loans. They do not need to be consolidated. There's ways and tricks to increase the pace to get the documentation. Otherwise, you get into a paperwork line, okay? And we want to avoid getting consumers in that because then they won't be able to make their close dates. So that's case study number one. Those are all the issues we help Jane solve. So now I want to talk about case study number two, which is Joe. And I know this video is going on for a while, but it may be really, really helpful if you're a loan officer or a consumer with a lot of student debt who's going to try to close on a home. It's really important to learn the mistakes that can be solved so that you don't get unnecessarily declined, or you as a lender don't unnecessarily decline student loan borrowers that do not need to be declined. They do not need to be declined, okay? In most instances, it's just a paperwork or several phone calls or letters to a loan servicer that can get the paperwork and the results that the consumer needs. Okay, case study number two, Joe. Joe was told by multiple lenders he doesn't qualify for a mortgage because his student loans are too high. The loan officers did not know of different various student loan programs that that Joe could go into. And he heard from a loan officer, hey, I heard about this company called LoanSense. Go check them out. They may be able to consolidate your loans. And people oftentimes use the term consolidation, even if it's not necessarily consolidation. So Joe comes to us. He chats and says, I'm not quite sure how you can help me. I have $150,000 of student loans, and I have some credit card debt and some other things, which is preventing me from being able to buy, and I need to build a plan. I need to build a plan on how I can get to closing. For my area, it's a lower cost. Joe lives in Michigan, so it's not an extremely high cost area. He's trying to close on a house that's a little under $200,000, not extremely out of reach for his $80,000 income. So Joe comes to us, and Joe, by the way, has been working for. He wants to buy. He's actually been working out of school for about 20 years now, and he is ready to buy because he's tired of being a renter, and he now wants his 7 and 9-year-old children to have a place in a school system that they don't have to keep on moving and moving schools. So he's finally like in a place with his life in which he's like, hey, I've moved up ranks and now I'm ready, right? So Joe comes to us. Not only do we get him into an income-driven repayment plan, that's just the start of it, but we qualify all his loans for forgiveness. So because he wasn't in line for an immediate close, he had the 2 to 3 months to actually file the IDR account adjustment. And he got, listen to this, he got all his payments counted towards the account adjustment of the 240 payments. He's made a lot of it in standard and a lot of it in there was a lot of different forbearance, which they counted them all. And Joe was actually able to get his student loans after about a 3-month period to 0 and got his loans completely forgiven and was able to go to the closing table with a $0 balance. All for our service price is $249. We did all that for him for $249 because it's not just the filing process, but it's the knowledge that we're able to impart on the consumer and of course help the lender. And we immediately put the lender that sent Joe to us in the loop because he asked us to, and the lender was aware and he was able to come to the closing table much sooner than he had anticipated because he thought he had to pay down much more credit card debt and all these various things that he had to save up for besides the down payment. And it turns out that by getting his student loans relieved, he can then save this $0 payment time to pay off credit card debt. But he was able to close even before he touched his credit card debt because his back end ratio worked out with his income and now having a $0 student loan payment. So those are some huge cases we see all the time that borrowers come to us and lenders and loan officers send people to us. So if you're a lender, you can automatically gain benefit from our software and our program by signing up for completely free use. By the way, you don't even have to, you can choose when you send a consumer to pay their fee for them or have them pay, but a lot of loan officers will pay the fee, especially if they see the benefit for that consumer in terms of being the difference between being able to close or not close. And you can do all that by going to lender.myloansense.com. We will provide the link in the description. You sign up for a dashboard. We give all consumer data back in that dashboard. You can directly invite your clients and we'll follow up with them to help them get started within our platform. We are tech plus humans. So we liaise all the paperwork process through our platform, and we are on standby to answer borrower and loan officer questions. You can schedule time through the platform with an advisor, and your customer can also, your consumer or client, can also schedule time with an advisor through our consumer-facing side of the platform. You can get estimates on student loan adjustments and improved purchasing power before you even invite. You also can get a lead capture product, like a consumer lead capture tool to put on your website by signing up at lender.myloansense.com. I hope these use cases highlighted the value that we can do as a partner to you, as well as the knowledge we can help consumers build in advocating for themselves and working with them so they can get to closing. We're on standby, cannot wait to work with you all. I hope this information was helpful. And if it is, please subscribe, like, and share. Have a great day. Happy New Year.